Well, the start of 2021 was bleak, with the world still in the grip of a pandemic that had already decimated major economies. The outlook now is more positive. There is a sense of hope thanks to progress on the vaccination drive and the easing of coronavirus restrictions. The global recovery is backed up by huge levels of monetary and fiscal support, as well as improving growth and earnings, which have translated into significant rallies in most equity markets. However, rebounding economies also bring uncertainty. Inflation is ramping up and monetary support will soon start to unwind, putting countries' employment levels at risk. With geopolitics also back on the agenda as the Biden administration engages with the world once again, any decision there has the power to move markets. At the same time, the vaccination program has been uneven, with emerging markets getting the short end of the vaccine stick. And let's not forget, the COVID crisis is far from over. So as we enter the second half of the year, what is the outlook from here? Welcome to Pocketful of Dirhams. I'm Alice Hain, and joining me today is Sami Shah, Chief Economist at Swiss private bank Lombard Odier, who will tell us what to expect next. If you want to get the latest episodes of Pocketful of Dirhams, make sure to subscribe on your favourite podcasting app. Welcome back to the show, Sami.
Hello, Alice. Thanks for having me.
Now, in January, I think we were all losing hope a little. I don't know about you, Sami, but I was enduring my third lockdown, this time in England, and there was a sense that it would never end. So for investors, that might have seemed a sort of quite a negative thing. But despite the dip at the start of the pandemic, the markets have remained resilient. Why is that?
So it's clear that in January, we were still in the middle of the tunnel, right? And it doesn't seem that the light was imminent. However, if you remember, we started to have very good news on the efficacy of the vaccines in October, November, and December of the year before. So as you know, markets tend to be forward-looking. And basically, the market narrative was that by let's say the summer of 2021, mass vaccination would have been achieved in some parts of the Western world, and therefore we would be in an environment where reopenings and decisive reopenings were possible. So although we were still in the middle of the tunnel, it's clear that the light was coming ahead, and therefore markets were looking through basically the difficult period because they knew that as the vaccination process was unfold, we were going to be able to reopen the economy and basically economic activity was able to revive. And the second element I would mention on why markets were on the positive side in January, despite the lockdowns, is that in December, we had a pretty substantial rescue package coming out of the US, $900 billion. And the Biden administration was already hinting at another rescue package in the magnitude of the trillions of dollars. We indeed got 1.9 trillion in March, but it was already discussed, I would say, as soon as January. So very clearly, the fiscal support out of the US and the efficient vaccines were the two reasons why basically markets looked through and remained in a positive trend.
So a lot has changed since then. Vaccination programs have ramped up particularly across the sort of developed markets. So what can we expect from the second half of the year now? Is it all onwards and upwards from here?
I would say the main characteristic of the recovery, especially thinking about the second half of the year, is how this recovery is playing out in sequence, right? It's not everyone recovering, growing at the same time, at the same pace. Now, very clearly, the recovery started in China, in the goods sector, and in the trade of goods and the production of goods. And then it rolled over in the US as they were at the forefront of the vaccination process. And basically what's happening now is that Europe is taking the relay, right? So we have this rolling recovery from China to the US, now to Europe, and perhaps with a bit of luck and probably with a 6 months delay, at some point, we can imagine that in the large, hard-hit emerging markets, we'll see, activity rebound perhaps later this year or eventually at the beginning of 2022. But very clearly, this rolling nature of this recovery is what's playing out. And now is Europe's turn. So I think in the coming quarters, we're going to see a lot of pent-up demand in Europe as basically the continent has achieved or is close to having achieved mass vaccination, and the reopening is allowing again for people to consume. The final thing I would say about this rolling recovery and what to expect in the second half is that, we've just had the discussion on basically the change in leadership from one region to another, but it's the same when it comes to sectors, right? It started with goods, it started with trade, it started with manufacturing, and now very clearly the service sector is going to be at the forefront of this recovery. It's going to be the key driver of the recovery. Spending is shifting from spending in goods to spending into services. So when I think about those two elements, Europe and services, it means that the recovery still has legs, and the fact that it has a rolling nature means that we're going to enjoy this recovery for quite some time, unless obviously something comes in the way.
So that all sounds quite positive, but as you're saying, unless, and that's the key word. So what kind of risk factors should investors be thinking about now? We still have the Delta variant to contend with, such as in the UK particularly. So what should we be aware of?
Well, the first key risk is, as you mentioned, remains the pandemic, right? Is that at some point, because the vaccination process is too slow in some parts of the world, we see variants developing, and obviously the worst case would be a variant that is vaccine resistant. I think the great chance we have currently is that the vaccines are efficient against all known variants, even the Delta variant, right? So it's very clear that vaccines are efficient. They prevent serious cases from developing. They reduce the death toll, and that is a net positive. It does mean that we need to push the vaccination through, but obviously the key risk to the outlook remains that the vaccination can be too slow in some parts of the world, and that at some point we have a variant that is vaccine resistant. Thankfully, we are not there yet, but we need to be conscious that unless we get vaccination through extremely quickly, there is always this risk that a variant that is resistant develops, and therefore that brings us back to square one, basically. So hopefully it won't happen, but we do remain very vigilant. The other risk basically has to do with the policy response, which is that a too soon removal of policy support, whether it's on the monetary front or the fiscal front, would obviously come as a risk because the recovery is still young in some parts of the world. Perhaps it's being more mature in the US, and that can leave the Federal Reserve, right, eventually review some of its emergency policy. But we need to keep in mind that typically in Europe, we are still technically in a double-dip recession, right? We haven't yet had a positive quarter in 2021. So it's a little bit too soon to imagine that we can withdraw some of the policy support. The recovery still needs to be secured by this policy support. So we would see as a risk any premature withdrawal either on the monetary side or the fiscal side, especially in Europe and in some emerging as well. So there is a policy risk here, thinking about the recovery. And perhaps the final risk that we might discuss a little bit further is obviously, well, perhaps with all this stimulus, there might be the risk of overheating the economic machine. We've discussed a lot about inflation in the US, and perhaps if it gets out of hand, it would force the central banks and the policymakers to withdraw policy a little bit too harshly. So that would come as a risk. So we really see those three big risks: the pandemic, too soon withdrawal of policy support, or on the other hand, a potential overheat that gets out of hand.
Now, you mentioned inflation there. Some economists have been getting very uptight about that. Some of them think it's going to sort of soar out of control. Others see it more as a sort of temporary blip. Is that a concern for you? Do you think there's going to be wider implications for the markets?
No, so we're very much into the transitory camp here for a certain number of reasons. Now, the first reason is, if you're worried about something, well, you might as well look into it. And when you look into the inflation data that we've seen in the US, it's very clear that most of the sharp increase in inflation is due to very temporary factors and mainly base effects. So base effects from oil or base effects from the reopening. So the fact that inflation in the US is concentrated in a very limited number of subcomponents means that, again, we don't have a broad inflation issue, right? It's really the reopening and the base effect that explain 60 to 70% of the normalization of inflation. So that's a big reason. Again, the fact that there is no breadth into the inflation report, in our view, shows how transitory this mechanism. And at some point, we will digest the base effects from oil. We will digest the base effects from the reopening. Now, another important reason why we're in the transitory camp is also all the bottleneck story, as they are bottlenecks indeed. But they are bottlenecks because there is very low inventories. Right? During the crisis, companies have drawn from their inventories because they couldn't produce because of the restrictions, or they didn't want to produce because of the demand uncertainty. So they used inventories. It means that today, we have the capacity to respond to some of the demand, but we don't have the inventory. So we lack a tool to respond, I would say, to the recovering demand. And that is something that is transitory in nature. We will rebuild inventories in the quarters to come, but it takes a bit of time. Right? And the final argument for us being in the transitory camp is simply the labor market in the US. There is, some tightening going on, but I mean, we're still in an environment where there is a lot of slack, in our view, in the US labor market. There is still around 9.5 million workers who haven't recovered the job. These workers, perhaps they are not willing to seek for a job now because they still benefit from, the unemployment insurance. They still have restrictions, or eventually their kids can't go to school. But at some point, these 9.5 million people, they will start looking for a job again, as soon as now, or at the latest in September. So there's going to be a lot of supply of workers in the US economy, and that obviously means that it's going to reduce some of the short-term tensions that we've seen. Perhaps a final point on inflation for those who have experienced inflation in their life. When you have inflation in an economic system, inflation is usually everywhere. It's in every sector. It's everywhere in the economy. And to be fair, it should be everywhere in the Western world as well. If we were about to witness a shift in the inflation regime, we shouldn't only be seeing inflation in the US, right? It would be broad-based because supply chains are global. So we should be seeing a bit more inflation in Japan, in Europe, in Switzerland, or even in China. And when we look at inflation globally, there are absolutely no signs of a regime shift when it comes to inflation, right? Inflation remains very well within a medium-term range in China, or even in Israel. If we take the example of economies that have reopened ahead of the others, we see very little signs of global inflation. We have some in the US for very specific reasons, but at some point, these reasons will be digested as well. So, we're about to see, I would say, inflation probably roll over in the months to come in the US, and we don't see that as a persistent worry.
Okay, so you talked about the employment market there as well. You talked about the US. What about in the UK and Europe? I mean, in the UK, for example, government support is now being withdrawn gradually over the next few months. Is there a risk that we're going to see higher unemployment levels, and is that going to be a risk factor for the markets as well?
Well, there is always the possibility to have a policy mistake. If you withdraw stimulus too soon or too sharply, eventually you run that risk. But the reality is that the UK economy is recovering extremely, extremely strongly. And Europe is about to recover extremely strongly as well. As you reopen, again, there's pent-up demand, and you see revived economic activity. So it's normal as the recovery unfolds that slowly but surely, and gradually, you remove some of the emergency schemes that were there to compensate for some of the damage from the shock. And now, as the recovery basically is becoming more mature, it's becoming more evident. It is indeed time to remove some of the emergency schemes. I think the recovery is strong enough to prevent that gradual normalization in policy to be disruptive economically and to lead to higher levels of unemployment. Quite the contrary, there is demand for jobs. There is reviving economic activity. So it's normal as the patient gets better that you slowly but surely reduce some of the medication, and if it's done in a gradual way, the economy should be strong enough to offset basically the slow removal of the policy support.
Now, we also have the geopolitical factor to think about. President Biden has got his Build Back Better campaign on the move. How significant is that? And any possible big sort of trade moves on a global level, how significant would they be for the markets?
Well, the infrastructure projects by the Biden administration is very promising in our view, right? There is something unorthodox about what they're doing. Usually, you have, what governments do is that they go into counter-cyclical fiscal policy during a shock. And once the recovery is well in place, well, basically, they slowly remove the fiscal support. Now, what's happening in the US is different, is that as the recovery is unfolding, rather than reduce the fiscal support, they kind of double down. And the reason they're doing so is that they're not doing some emergency demand support schemes. Rather, they're doing long-term supply investment schemes, which is necessary in some of these segments of the US economy where we have seen underinvestment through the decades. So, thinking about the US economy, thinking about the polarization in the country, about the lack of investment in education, in healthcare, and in physical infrastructure, it makes a lot of sense that they try to compensate for decades and decades of underinvestment. So we see that as a net positive, something that is necessary, something that makes a lot of sense. And we do hope that the Biden administration will be able to push through these measures before the end of the year. And we're seeing something slightly similar in Europe as well, with the EU Next Gen Fund, which again is playing out and is being deployed as the recovery is starting to be on stronger footing. So that comes as a security, right? It secures the recovery, which is something I would say quite remarkable, and that we see again as a net positive, because you're going to invest in the economy and trying to again strengthen the productive tool. Now, when it comes to the other risk that you were mentioning, which is trade, I would say, compared to where we were a year or two ago, the multilateralism approach of the Biden administration obviously removes one risk, especially when we think about the traditional trade partners of the US, Mexico, Canada, South Korea, Japan, and Europe. I mean, not so long ago, there was the risk that the US would put tariffs and sanction the Europeans for doing their digital tax. Now, that risk is totally out of the table now, right? And you've seen that they've even settled the Airbus and Boeing situation. So on the trade front, I would say things are going better, especially with the traditional allies of the US, but obviously remains the difficult relationship with China, which is something that we'll have to carry out and that will continue to be a risk to the outlook for the next decade, right? They're not going to settle that situation in the short term. So that is something that is well known. That is something that hasn't changed with the new US administration. Clearly, the US-China relationship will continue to be complicated, but at least when it comes to the traditional partners of the US, things got a little bit better.
So looking more closely at the markets, which sectors do you think are going to see a rise in equity prices in the second half of this year? And at the same time, which sectors are going to struggle?
I would say that globally, we expect lower returns in the quarters to come versus obviously the past 12 months. So, we've had a very sharp recovery, a big rebound in asset prices, which are obviously, when it comes to equity markets, all close to their all-time highs. So we still expect, markets to move higher on the recovery. Now, maybe it will be more volatile and maybe the returns won't be as appealing as what we've had. But, we still feel that there is room for improvement here, mainly because, again, with the recovery, we're going to see profit growth ahead. And that should help, markets move higher. Now, the very important recommendation that we make is at this stage of the cycle, we need to remain cyclical, right? So this is still a time for us to give the benefit of the doubt to the recovery. And, we want to have a cyclical tilt in our portfolio and in our equity positioning, which means that, we favor cyclicality, industrials, materials, small and mid caps, value trade. We still believe that we've seen a lot of that trade unfold, but we still believe that there is a bit more to do. So all that cyclical tilt, we play it regionally. We play it when it comes to sectors. We play it when it comes to size. And clearly now is not the time, basically, to get more defensive, especially in the equity allocation. So we're sticking to the cyclical trade here.
What about currencies? What's the outlook for the dollar, the euro, and the pound? What are we going to see here?
So we don't have huge expectations when it comes to these crosses. We have a target for the euro dollar year end at 123. So we're not extremely far from that. Around 120 seems to be a long-term fair value for the euro dollar, and we're very close to that. So we do not feel that there is a lot of potential in that trade. Eventually, maybe a little bit more to do within the emerging market currency space. We like the renminbi. The Chinese are in a more mature phase of their cycle. They are more advanced in the tightening of policy measures, so that is favorable to the renminbi. So that is one thing that we would do. But for the rest, we don't feel that there is many very, very stretched bets within the major currencies. So within portfolio, it's mainly a dollar yuan story rather than euro dollar, let's say.
The other big theme, I think, for the second half of this year in the run-up to COP26 is the green transition. I mean, that's all I ever hear spoken about at the moment. How important is investing in that in the run-up to the big environmental summit in November?
It's extremely important because all the main economic actors are jumping on that trend, right? You have no choice, basically, if you are an entrepreneur or if you are in the industry. And if you think about the policymakers, it's very clear that they've embarked in that trend as well, right? If you consider the policy response we had after the great financial crisis, it was a very, I would say, traditional counter-cyclical response, and there was no green element to it. Now look at the response we had when it comes to the COVID crisis. A third to half of the response has to do with improving the energy transition, green elements, digitalization. So something that is very promising. I would say it's clearly not enough. It's just the beginning of the story. But I would say, even when it comes to the policymakers, it's very clear that these programs have a green identity, and it does mean that as investors, this is a very important thematic that is clearly represented in our portfolios.
So to summarize, what are the three big things investors should look out for in the second half of this year?
So the first thing is to continue to monitor the recovery and its rolling nature. It's going to be the turn of Europe. And what we want to make sure is that at some point, if the vaccination process goes through, the next in line will be emerging markets, right? So we're going to monitor very closely the recovery and the vaccination process, especially in the emerging world, to make sure that we avoid the risk of having a vaccine-resistant variant, but also the vaccination in the large emerging markets would allow the recovery to unfold there as well. So something that we're watching very closely. Another element that we're watching as well is basically the change of language from the US Federal Reserve, right? As the recovery is maturing in the US, it's becoming clear that the Fed will probably very slowly and gradually remove some of the policy support. So we do expect the Fed to signal asset purchase tapering in the second half of this year and to actually execute the tapering in 2022 and then to raise rates in the first half of 2023. So we think that timeline is still very, very valid. But again, shifting from the shift in stance in policy is something that has to be watched very closely. The market's prepared for that, but there's always an element of discomfort when the Fed has to shift a signal and engineer a policy that is a little bit less expansionary. So we will watch that very carefully. And finally, an element that we'll be monitoring as well is indeed the commitment to the green thematic, very important in our view. And we want to reward and we want to be exposed to the economic agents that are at the forefront of the green revolution.
Thank you this week to Sami Shah. If you would like advice on your personal finance issues, you can write to me on pf@thenational.ae, and remember that PF stands for Personal Finance. Please do subscribe to the podcast in your podcasting app to get weekly updates and leave us a review so we know what you think. This episode was produced by Arthur Edison. I've been your host, Alice Haim.